And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody out there. Welcome to the Coach's Playbook. We got the whole gang back together this week to talk about some of the most popular indicators. But as we were talking before, I think a lot of this episode is going to be more assessing the value of indicators and how they are used. Mick is back. I understand you have a trader shout out for us today.
I do. Big shout out to Yao Jen Wang. Up about $9,600 today, most of it being in the crude oil, actually. So kudos on catching that move.
Way to go there. Yeah, that's a big day. Big day in a lot of names in the stocks today. Not as much interesting in the indices, but man, there's a lot of stuff going on this week. Watch out for the Fed. They're coming
tomorrow.
Seems like only 6 weeks ago, because that's how it works. So today we're going to go through some of the most popular indicators. We all have one or two that we might discuss, but I think I'll send this to Hogue first today and we can join in on this discussion.
Can we just say that it's always Hogue first?
Oh, it's not. You complain and then I do it to you. First. It's like every fourth or fifth one I sent to one of you guys.
I thought you were going to kick it to me because I'm rusty.
Yeah. Why would I kick it to you? Because you're rusty.
Put me on the spot. Make me look bad on live television.
All right, Hogue, show them why you're number one.
Well, indicators, there's 1,000 of them. And I don't really look at any of them.
A ringing endorsement.
Yeah, I know. But I mean, yeah, there's different ways to look at markets. The indicators can give you an indication of, potential changes in the markets when there's a divergence between price and the indicator. There's let's say stochastics RSI, they're built to tell you when the market may be overbought or oversold. The divergence in them is, I think, one of the better things, and something I will actually look at when I'm thinking there might be a divergence. But if on a day-to-day basis or a trade-by-trade basis, if I'm leaning on those, they're lagging indicators, and I just haven't been able to find them that useful. And nothing on that note is always going to be useful. Nothing works every time, and nothing never works. It's all a matter of your ability to recognize what's going on in the market context. And these are all tools that can be helpful in market context, just as a profile trader and a volume and delta trader. That's the indicators that I'm really looking at. Now, delta as an indicator is quite simply put the number of contracts that trade on the offer, which is positive delta, minus the number of contracts that trade on the bid. Sometimes when the market is showing very aggressive sellers, in other words, very deep negative delta, but price keeps moving higher, that's a divergence. And that's something that I can use to tell me that, hey, the short time frame traders are probably the ones creating that delta, that negative delta, because they're the ones that are pointing and clicking and using market orders to enter the market.
Chucking orders. Yeah.
Right. So the fact that price isn't moving in the direction of the more aggressive traders gives me an indication that, maybe there's somebody else here. Maybe there's a longer time frame presence just soaking up what they can soak up. They're going to end up getting the short time frame too short. And at the end of the day, that sometimes that's when we see those late spikes or these later in the session moves occur, because you end up with your direct time frame, the shorter time frame pea shooters all one direction. They're not getting paid. They have to get out. They get out all at once. So it's a tool that has helped me be able to pit time frame against time frame, longer time frame against the shorter time frame. And the longer time frame usually wins. Not every time, like any of these indicators. There's always differences and things, the things that occur that we don't see or can't see. So, I'm not saying that any of these indicators are bad. They're just not as useful for me, I guess, in my experience, as they have been for many. That's just a start. On to you, gentlemen. What are you thinking?
Well, a few quick notes at the top here. We forgot to tell the viewers that Hoag's home is being torn apart right now. So if you hear anything in the background, that's what's happening.
I'll mute.
Oh, it's all good. He's getting some new floors. So one segment I'd like to add here that came up there with the Delta conversation is sort of like trader lingo, kind of one of those sound like a pro things. All right. Hit the bid, lift the offer. Two things to remember there. And I think last week we were talking about selling at versus paying for. Use those, you'll sound like a pro. And that's half the battle. So this could almost be changed to the title of Are Indicators Important? Now, today I was supposed to talk about the RSI, which is just like Hoag said, it's a formula you can look up that basically if it's above 70, it's overbought. If it's below 30, it's oversold. And ideally, you're looking for a divergence of price. Like we said, price is going down, but price is holding steady or going up, and the RSI is coming down. Those are interesting. But I think and I'm going to go to Dan next because he so wants to talk. But I find it, Dan, what you were saying before, there's only a few things that are just like true information. You have your price, you have the volume, and then beyond that, the simplest of all indicators are moving averages. And I think that they're important because everyone's looking at them. And I think the more obscure you get, with none of these indicators are going to work all the time. You can't make money just by selling when the RSI is at a certain amount. All of these indicators, the more complicated they get, the less people are looking at them. And for instance, the reason a 50-day moving average is meaningful is because people look at them. That's sort of the way trading works. You're not trying to figure out what you want to do or what you want the market to do. You're trying to figure out what other people out there think everybody else is going to do. It's like Inception. So Dan, take it away on your indicators.
Well, yeah, the first thing I want to say is Hoag mentioned this and he alluded to it, right? Indicators are a great thing to have, but they're market state dependent. So one that I like is an average true range. I look at the ATR when markets are range bound. When the market gets trending, I have a harder time with that indicator. It's not something that works for me in my style and in my strategies. So if the market is on a strong trend and making these breakout moves, that average true range you may struggle with. It's not going to give you exactly what you're looking for. For me, and again, every single person is different when it comes to looking at indicators. I look at that ATR quite a bit. When the market is range bound.
One note before you continue there on the ATR, I have seen some interesting strategies using the ATR as far as setting a trailing stop on like a swing trade or something like that.
For sure.
Now that's interesting. As Dan said, it's all dependent. Sorry.
Yeah, I want to talk more about that a little bit when it's my turn.
100% dependent on market state, 100% dependent. If it works for me, it doesn't mean it's going to work for you. And I think that's the first thing you have to think about when it comes to, oh, Mick, I got background noise over there. I was wondering what that was.
Sorry.
So no worries. It's 100% dependent on you as a trader, your appetite for risk. There are so many factors that are involved to it. So I will tell you guys, I use ATRs. I use VWAP. VWAP, and I'll tell you why I use VWAP. VWAP I use strictly for the mere principle that it keeps me in check. It's an accountability indicator for myself. I run the standard deviation off of VWAP. And if I find myself liking a trade, but I find I'm too far away from VWAP, I'm going to double check what I'm doing and ensure I like my trade. I'm not using it as an indicator in a sense of, hey, this is a sign to get in. I'm using it as a reference point. Hey, staying accountable to my plan, am I liking this location to enter this trade? Now going what Jack talked about, to me, there are two true facts you get in trading, and that's pretty slick in my opinion. It's volume and price. There's no lying in those two when it comes to futures trading. That's the difference between futures and Forex. And futures, you get legit true value of volume. So Hogue talked about divergences. You have volume divergences, right? Basic principles of volume state: if volume continues to come in and price continues in the direction, look for price to continue. If that volume starts to die off, look for price to slow or potentially rotate back to the other direction. So there's some standard principles of volume. I like volume, especially because if I see volume coming in heavy day after day on a directional move, hey, maybe the buyers are really strong here and it's giving me some true indication. It also helps me understand when I look not just at the daily volume or volume per price bar, but also volume at the price at they're traded, right? So you can put up volume profiles. Another one of my favorite things to be looking at. There's a lot of different ways to look at volume. Hogue, you talk all the time about volume profile or market profile, which talks a lot about volume. There's so many areas of volume that you can pay attention to that you're getting true activity at certain prices and specific times. That helps me go to my bread and butter, which is defining my own levels. My levels are defined by price and volume and time. Those are the three things that I like to look for. We lost Hogue. Those are the three things I like to look for when it comes to trading and indicators. But at the end of the day, no indicator is perfect. If there was, everyone would be looking at the same one.
Exactly.
They're constantly changing and everyone is market state based.
Well, we'll muddle on here without Hogue. We'll find a way to go on. And like I said, with volume is ultimately sort of, I talk a lot about, the title of Nate Silver's book about statistics and stuff, signal and the noise. Volume is your signal, right? The more volume you have, the more signal there is, and the less likely there is to be noise. That's why you'll see weird moves in overnight markets when there's not a lot of volume. The more volume you have, the more validation there is for whatever's happening in the markets. So that's an easy psychological way to think about why those volume divergences make sense. Mick, what's going on in the office?
Very well said. Well, I've got Brett next to me. He's on a phone call. So hopefully there's not too much background noise while I'm talking, but it was pretty good for the most part because he's been on the phone the whole time. So I've got my notes for my part today, and I'm kind of blocking my microphone here right now. Seems to be effective, I suppose. Regarding indicators, I mean, there's like Hogue said, there's a ton of them out there. Don't really, think that many of them are great. Very complex stuff. I like the simple things. Everything I'm going to mention is something that was listed here already. We were talking about volume and market profile. I think market profile is great because it tells you, where the points of control are, where the interest is, what price points are important. And, commodity futures are here for producers and users to hedge. So while there are speculators looking to make money, price is very, very important. So being aware of where the interest is at certain price levels in markets is a bit of information for you. Any indicator is going to be just a tool in your toolbox, really. But so I like market profile. I don't personally use it as an indicator on my charts. However, I could basically tell you where the points of control are by looking at the charts just based off of congestion areas. If there's a lot of price bar overlap in a certain area, there's going to be high volume there. I still can see what time of day that price action was trading at there. So you can kind of eyeball market profile just by looking at a chart. Average true range, I wouldn't even call it an indicator. It's a metric, and it's based off of, I like average true range, 30-day average true range. As I said, I don't view it as an indicator, but I view it as a tool to consider what risk I may need to assume and what reward could be reasonable. A market that's got a high ATR, average true range, you might need to give it a little bit more room. Something with a small ATR, you could probably put your stop and profit target in a little bit closer to where that market is. I like thinking of ATRs in dollars per product. So if crude oil's average true range over the last 30 days is 200 ticks or $2, it's got a $2,000 average true range. So I know if, I buy the high of the day and it goes against me, I could be out at $2,000 on every one lot. So I like ATR a lot. I know some very smart traders that, got me into looking at that. So I still look at that. Moving averages, like it was said, I mean, we have our basic moving averages, the 50-day, the 100-day, the 200-day. While I might not be, some people might want to base their trades off of, crosses on the moving averages, or if we're above this, we want to do this. That's all fine. But I think being aware, for me at least, being aware of where those are is a good thing, because most of the other professional traders out there are aware of where those are. So I want to be aware of the price levels that other people are looking at. So if, excuse me, if it's not a moving average, I might want to, if I'm Dan, I want to know what settlement from yesterday was. Everybody knows the settlement. Me more so, I want to know previous day's high and previous day's low, or the swing high, or recent swing high, or recent swing low. Those are, and if you're looking at a daily chart, like I like looking at, those are levels that everybody else is looking at. Swing highs and swing lows, whether it's, previous day's high or low or a bigger swing, like people are looking at that, because at those levels, and I mentioned this before, that's where if you're going to get price continuation or expansion, or if you're going to retract and come back in and have price bar overlap on the channels.
Before you go to your last thing there,
Please.
It's just, if you look at the charts, you can just see that there tends to be action around those big moving averages. And I mean, people are always grasping for some level, somewhere to kind of have a fight, so to speak. And it tends to be around those moving average levels, those big round numbers. They're not necessarily indicators, I guess, technically the moving averages. But wherever you're trading, you need to know where those are. I think that's a good point, because they'll affect your trade.
And to what you're saying, and this is more so about the swings than the moving averages. I've been on calls with traders a number of times, and they're like, "Oh my gosh, what just happened? Something just moved X amount." They think it's a big move, and I'm like, "Well, you're looking at a short time frame chart. You probably missed that we just took out previous day's high or previous day's low, and that's why we got the goosing, because there's new entrants into the market to try and hammer or catch a ride on that price expansion." The last thing I'll mention, and this was something Hogue brought up, is the divergences. Looking at momentum, I like looking for, on a higher time frame, like buy divergences and sell divergences. There's nothing better. I shouldn't say nothing better. One indicator I'll actually use to base trades off of is these stochastics and looking for momentum or divergences. If you have a market that's trending higher and there's a pullback in price, and prices make new lows. However, the momentum does not make new lows. I like that scenario where I could get in on the trend in one direction. I like seeing price making new lows, but the momentum not. And then you can hop on something and maybe hold it for a couple of weeks, or work a long or short position intraday for a couple of weeks if you have a higher time frame bias. So I will say I've played around early on in my trading career with a bunch of indicators. Never found one that could make me money. It's more about, price location and stuff like that for your trades. The last thing, and I don't use them, but I could see value for someone who's intraday trading, relatively active. I think day traders make most of their money catching a piece of the trend for the day. And I think a helpful tool you never hang your hat on any of these indicators or tools. It's a great thing if you can see a couple stars aligning, this indicator showing you this, while this one's also backing that up in a different way. But for day traders, you want to catch a piece of the trend for the day, you could maybe start out by looking at something as simple as Keltner channels. In a trending up market, you want to be buying at the lower end of that channel and, peeling off or taking off risk or profit at the higher end of the channel, and vice versa if it's a downward spinning market.
I want to add one thing to something Mick mentioned, just about like, when you see the goosing as market approaches those, prior day lows, the thing you have to think about with key levels, whether they're high volume areas, whether they're swing highs and lows, whether it's a settlement price or points of control or unchecked points of control, they are never going to support and resistance. I think people look at it like if the market's above and it moves to a price, a level down below, the first instinct, oh, it's coming to an area of resistance. That's not the case. Resistance and support are all in hindsight based off of how that market reacted at that price point. What happens as the market starts to approach, it's going to attract new activity. And that activity is not specifically buyers or sellers. You're going to find activity coming in based off of what people are looking for based off their position. There may be a lot of other extenuating factors. Mick mentioned that the commodities are used for hedging large positions. And that's something you want to think about. So if you see price starting to approach a level, don't think instantly, okay, this is going to be a reversal. It may accelerate through. And that's really the key thing you want to think about. There are areas we've talked about in my Topstep all the time as areas of importance or areas of inflection. You may see new participation come in at those price points, and it does not give you an indication if it's going to go higher or lower, just that there is an opportunity at that price.
Well put. I think we're all on the same page, and this would be, I think, a good concluding section, is that at best, most of these indicators can only alert you to something to take a closer look and then start looking more at the price and volume and other, historical highs and lows and things like that. I can't really endorse anyone that is purely buying or selling based on some indicator. Because as we said, if it worked, it wouldn't work for long because people would catch on to that. So at best, it can inform you where you might want to look to put on a position one way or the other. But I think ultimately it should be based on just price, time, volume. Get back to that. Get back to basics. Any final thoughts here from either of you?
Yes. I was just going to say, trade location is the most important thing. And these indicators can be, if we get in a good trade location, indicators could be used to, help us exit a trade or for a loss or for a winner. Again, just tools, but that's all they are.
I think that could be helpful. I think that maybe people, as you said, getting out is just as important as getting in. And I think people think a lot about trade entries. And there's not that much. I think you're in the top third or fourth of retail traders if you are, just setting a bracket even that has a set profit target and stop. But there's a lot more strategy that can go in there as far as setting where you're going to get out when the condition of the market looks different. That is just as important as exploring where you get in. So I would encourage people to think more about trade management and the reasons that would satisfy you to get out of a trade, be it for a winner or a loser.
It's great you mentioned that, Jack. Well said.
You know what? I'll take it. Hoag's not here, so I gotta.
Did he run out to grab lunch for all of us or something?
Yeah, I guess I didn't mention Hoag's internet died. As I said, they're literally, it sounds like tearing apart his house brick by brick. So pray for Hoag. Dan, do you have a quote for us today?
I do. I think this goes well with, indicators. It's from Alexander Elder. The goal of a successful trader is to make the best trades. Money is secondary. Look for your key opportunities, trade to your system. And, that'll be the best way to be successful at this.
Very good point there, Dan. Well, that's all for this week. Since Hoag's not here, thank you, Dan. Thank you, Mick. I'll sign us off this time. I'm trying to remember what Hoag says at the end, something along the lines of, it's all a journey. Stay safe and trade well,
and
everyone.
Profit.
And
go
profit.
Forth
trade
and
safe
profit.
and go forth and profit. We'll see you next week, guys. Have a good one. Bye-bye now.